Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. I'm your host, Joe Mosier, and as always, thank you for spending your time with us today. A quick reminder before today's episode, if you haven't done so already, now is the perfect time to subscribe to this podcast and ensure that you never miss any of the content or the conversations that we publish here each week, all in service of our mission of improving your results in your agribusiness through better strategy execution. Now on to today's episode. I'm excited today to share with you my conversation with Levi Hall, Chief Operating Officer of Horizon Resources, a farmer-owned ag cooperative based in Williston, North Dakota. Now, what you're going to hear in this is that on the surface, Horizon Resources looks very similar to other co-ops across the country. They've got divisions in agronomy, energy, feed, grain, and retail. But there's a couple of notable differences. One, of course, is the distribution of the gross revenue contribution that comes from their location upon the Bakken formation. And you'll hear about what that means for the business to be in such an energy-rich environment, given the volatility of the actual underlying energy industry. You'll also hear us talk a lot about the fact that 95% of Horizon Resources grain origination is actually in commodities and products that don't have futures contracts and options, and things allow them to hedge their position, which means that the overwhelming share, if not nearly all of their origination, has flat price risk. And how do they actually manage that in the course of their operation and stewarding value for their farmers and member owners? And you're also going to hear a little bit about the ways that they're investing, and I think in a very different way, of actually educating their customers and their members, not just in about the business and the futures markets and the latest in agronomy and soil health, but they're also educating these folks in what it is that they own as members of the cooperative and how the decisions that get made affect them and how those decisions get made. So everything from behind the truck dump, behind the pit, what happens in the elevator, what are the commercial decisions that happen that, of course, affect the producer, but helping them understand what it is that they own and what a service that is to their membership owners. And it is this mix of challenges that you're going to hear that are shared by other co-ops, along with some of the differences and nuances within Horizon Resources, I think, to make this conversation worth hearing and a little bit different from what we've done in other conversations. So thank you, as always, for being a listener of this show, for being a member of the Pacesetter Pod community. And with that, here's my conversation with Levi Hall of Horizon Resources. Hey, Levi, good to see you today. Welcome to the Pacesetter Pod.
Joe, I'm excited to be on your podcast. Yeah, this is going to be a lot of fun.
It will be. And you're one of just a small select group of individuals who've been on the podcast who actually have their own podcast productions, which sort of just sort of organically occurred. And so I appreciate the sound setup and the studio you have and all that, a little bit envious. But Levi, as we get started here today, you are the Chief Operating Officer for Horizon Resources. Mm-hmm. It's an agricultural co-op in North Dakota. Tell us a bit about who Horizon Resources is, where specifically you guys operate, who you serve, and kind of the divisions or product lines that you guys have, service lines in your organization.
Yeah, you bet. So Horizon Resources was formed in 2006, but the parent companies go back into 1929. Williston Farmers Union Oil, which is based out of Williston, North Dakota. And that's up in the northwest corner for those of you that did not take North Dakota geography classes growing up. So very northwest corner, we're probably 20 miles off the Montana line and about 60 miles south of the Canadian line. That's where the headquarters main office is. And then we've got varying different assets that go into northwest North Dakota and northeast Montana. Our product mix, we are, like you said, a full service agricultural cooperative. So we have the grain division, which I still manage with my COO title. And then we also have an agronomy division and our energy division and retail division. A really unique thing about our cooperative is our energy division actually makes up about 50% of our gross revenue. We're about a $400 million co-op in total sales. which in North Dakota is a fairly large cooperative. Across the entire U.S. is a fairly small cooperative. So real interesting. North Dakota has been very merger averse. And so we have a lot smaller co-ops. Our area typical yields are 35 to 40 bushels for durum. And so, that's obviously very different than you get into Iowa and southern Minnesota and other areas of the world where you're talking about 250 bushel corn to really drive those dollars of sales.
Yeah. I want to talk about the refined fuels and just the energy division and the contribution it has to earnings. But you made a comment that I want to pick at is, North Dakota generally being very merger adverse.
Yeah.
What can you share about that? What's, either a hypothesis or known fact around what drives that resistance to that? Has it been just lack of necessity that they've made liquidity and strong balance sheets, or is there something else going on there?
Yeah, I think there's a lot of different factors. One, we are as a whole, North Dakota cooperatives are very sound cooperatives. Not a lot of risk taken, very much live on singles and doubles in the baseball analogy, and just typically a lot of long tenured managers. So, between the managers and the boards, they do a great job of taking their job very seriously, and that is protecting the members' equity, growing responsibly. And there's also always been a lot of respect for neighboring cooperatives. And I don't know that you see that in a lot of other areas where a lot of cooperatives will take the mentality of, that's really not our trade territory. We're not going to try and go over there. So it's been just a little bit of a different mindset. But yeah, a lot of these cooperatives are financially very sound and there's no necessity. I think we'll start seeing some necessity. Throughout the entire industry, we've seen a talent pinch. Everybody's talking about that. So I think that there's going to be a lot of mergers coming off of talent. And we're also seeing a lot more push, whether it's a feed retailer or a feed manufacturer or a CPP or CN manufacturer that comes in and says, hey, you know what, we want to work with the cooperatives or privates that have 100 locations, not the ones that have 2 locations. So there's really been a shift there. So I do think that it is coming. North Dakota is typically not known for being ahead of the curve.
Okay. That's interesting. And so much of it, there's a variety of stories that get told around mergers. We had a gentleman on who does strategic marketing and communications, largely for John Deere ag equipment groups. And he had made the comment that while many mergers, you tell a variety of stories around the value creation for the organizations, the opportunities made available to customers and suppliers. At the end of the day, it's usually financially driven. If it really is the underlying motivation for a lot of merger activity, whether it's pursuit of growth or pursuit of survival, right? Still financially driven. And so kind of going back to your observation around the bulk of the co-ops have maintained strong balance sheets and been very prudent and maybe cautious and risk off, of course, would support that, less merger activity. But let's talk about refined fuels, because this is one of the reasons we have lots of co-op leaders on, and they're always great discussions. One of the things that struck me that was so different about Horizon Resources, and you commented on it a moment ago here, is the 50% gross revenue contribution that comes from the energy division. Yeah. And I'm going to assume that that's primarily liquid fuels and refined fuels. And so you're sitting on the Bakken Formation.
Yes.
Which is one of the largest onshore oil fields in the United States. Anyone who didn't know Williston either didn't take North Dakota geography, as you said earlier, or didn't pay attention for the last 15 years and has never heard of Williston, North Dakota, which is kind of strange.
Yeah.
But, I'd like to hear more about how that relationship, that proximity to such energy abundance. I mean, obviously it's contributing a lot in terms of your revenue, but the energy markets are inherently volatile.
Yes.
And you see big price swings, which of course is one of the reasons that made Williston very attractive for a lot of extraction and fracking activities. And then over time, maybe less so. And so how do you guys, while it seems like it could be a real tailwind, I'm guessing it also provides some sort of challenges when things are not quite as lucrative in the energy market. So how do you guys manage that, having such a disproportionate amount of your earnings come from energy, given your location?
That's a great question. So yeah, roughly 50%, so around $200 million a year comes from our energy department. During the real big boom, so the boom started in about 2008 was kind of when the first little sniffing started coming around. 2013 was probably the peak of the boom. During that stage, we ballooned from, I believe right before the boom, we were around a $50 million co-op. When added a zero to that, we got just shy of $500 million. And a big reason for that was the lack of infrastructure that was out here. So through that time period, we were actually hitting 100 million gallons a year. We were up against allocations. We were pushing sales away from us, which is obviously very counterintuitive. But now what we've seen is, like you said, boom or bust. And we've gotten to a point where there's a lot less trucks that are on the road out here. The pipeline infrastructure is better. The technology has improved where these wells are able to go 4 miles horizontally underground now. So their reach is a lot larger. So there's less wells. All of that type of stuff is playing into it. You're also seeing a huge pressure. Hess is pushing towards electric fracking and doing electric rigs rather than diesel generation. So they still have a diesel generator on site to create electricity to power, but their consumption is substantially less. So what we've done is we've really focused. We've always tried to have a good wholesale agreement. And so we work real closely with privately owned retail operations. So any gas station that flies the Cenex Butterfly, which is a brand of CHS, is either a cooperative or they have a relationship with someone like us. So what we do is we help fuel those gas stations and put the Cenex Butterfly on their locations. So that's a really unique portion of our business. We've got over 10 agreements with gas stations that fly the Cenex Butterfly, get their fuel from us. And that's been a big driver to kind of level out some of that demand because, you know, right now we're looking at a softer oil economy. You look at all of the manufacturers and the producers that are out there, you know, crack spreads aren't real great. So everyone's kind of tamed down production right now. And so we really have to lean heavier on our ag sector and the core of our business, which has always been a nice, steady piece because people always need to eat. So in my career here, I've yet to see a quarter left black just because. So I think that we're going to continue to see the stable part of the business will always be the ag sector. And that is the goal is to continue to hit singles and doubles like we talked about. And the energy division is there to provide consistent revenue as well. But when the booms happen, lay on the gas and take advantage of it.
So you guys, in terms of your exposure to the energy markets, is it similar to what you would see in a co-op in, let's say, one of the I states in Ohio that has an agreement whereby they aggregate a bunch of fuel, propane or diesel or DEF or industrial lubricants, whatever it is, and then they are acting as a distributor and a supplier to their customers? Or do you guys actually, are you in the extraction business? Are you in the distribution business via pipelines, or just simply buying production from others and then being that intermediary transporting it and managing the position risk?
Yeah, great question. So we are strictly, we're very similar to any other co-op where we're buying the refined product and then we're marketing that. We're not involved in any of the upstream production or midstream, working on the pipelines, any of that type of stuff. There's plenty of private companies out there that do a great job doing that. We're not interested in being in that. What makes our business really unique is we have so much outside demand for refined products, where a lot of local co-ops focus very heavily on the ag demand. And so what you typically will see is a very consistent usage of gallons across those cooperatives. As the oil markets surge and depress, we see the demand for our fuel surge and depress. So that's what really drives ours. We've got a lot of customers out here that use 1 million gallons a year, whether they're a trucking company or we're going direct to locations. And so that's what really creates the volatility in demand for us.
That's interesting. kind of going back to, and I promise I will move on from this at some point, Levi, but it's a unique, we had Matt Smorch from Country Mark on here not too long ago talking about their, pure play energy cooperative. So but they are also in the extraction and some of the further upstream things. So this is still kind of a different use or different case study. As you reflect back on those boom years, and it started to bubble up in 2008. You said it peaked in 2013. And along that way, you all rode to 10x growth in gross revenue from 50 to nearly 500. You talked earlier about how the co-ops in North Dakota and that part of the country in general are generally risk off. They're cautious. They maintain that financial prudence. And did that test the cultural value around prudence and risk management, and being that there was such abundant opportunity available? Folks get caught up in things like that, right? And they get out in front of their ski tips and they take more risks and they start to speculate. And there's that presumption that these good times that we're in, tomorrow should look a lot like yesterday. Yeah. And so I wonder, did you see others fall victim to that, and how did you guys manage that to come through it? Or really, did you learn a lot and you kind of push limits and now you become more of a prudent organization as a result? Kind of a long rambling question there, but
yeah, there were a lot of things that were challenged in that time. Obviously, we're a producer-owned cooperative, and so the board of directors is 100% agricultural producers. Throughout Northwest North Dakota, what became interesting was the participation level within this new industry and this new exciting industry. There's some cooperatives out here that built housing units and said, we're going to participate in the housing market because that was also really hot. There were cooperatives out here that used track that was explicitly for grain loading, and now they were unloading frac sand to provide for these frac wells. So there were a lot of different cooperatives that tried a lot of different things. What Horizon Resources did was a little bit different. They said, we're really good at refined fuels and marketing refined fuels and handling refined fuels and providing the service behind the refined fuels. We're going to stick to that, but we're just going to do it at a 10x level of what we've been doing it at. And that's what the real differentiator was. This cooperative did not get outside their skis. We didn't go build 5 truck stops in the middle of nowhere just because trucks were rolling by these highways. And so we've seen some of these other cooperatives that have overbuilt assets that maybe got themselves in a little bit of sticky positions, just expecting the oil markets to stick around for 100 years, 50 years, whatever it was. Maybe got a little bit more focused on what was right directly in front of them rather than looking at what do we expect this market to evolve to and which way is the best for us to ensure that we're going to be able to celebrate our 100th anniversary in 2029.
Yeah. So I love the fact that there were actual versions of that story in your neighboring co-ops that played out differently. Not because I want to see other people suffer, right? But it shows that there was decisions played a role. And
we saw some that made decisions that our cooperative did not make that worked out really well for them. So, it's not just that we did everything perfectly. There's a cooperative about 60 miles east of us that built a truck stop that does extremely well for them. And it's right across the road from another gas station they own. So they went from a real small gas station in town to just on the other side of the highway building a big truck stop. That worked out great for them. So everyone had to kind of make their own decisions. I don't know that the board of directors would change too much about the way that they handled it now, knowing what they know. So that's a great position to be in, that we did the best with the information that we had. Maybe we got an 85% on it, but that's a great grade.
Yep, for sure. And I think, what I want to highlight here is you made the comment around, we made the decision. So it was an explicit decision to stay within what we knew we were good at. We were great at originating, aggregating, and then marketing refined fuels for our supply relationships. And yes, perhaps some opportunities left on the table, right? But that was, what that tells me is that was a leadership team and a board engaged with membership to say, we actually do have a clear sense of what our capabilities are. We know what our business and our strategy is. And so we're going to look at this tailwind, this significant tailwind, which creates all sorts of attractive options that you might not always consider.
Right.
We're going to look at that through the lens of what we know we're good at. And the best path for us in this case is to simply 10x on a volume side and a revenue side what we're already doing.
Yeah.
And we'll lay off some of that risk. And so again, it's not really about calling balls and strikes and saying who is right or wrong or trying to armchair quarterback something years after the fact. But I think it kind of goes back to that importance. It's an illustrative example of the importance of having a strategy and having an aligned view on your core capabilities, both among the board and leadership, because that's a great litmus test for, hey, this seems really lucrative, but do we have any business doing it?
Yeah. And I think that goes back to the risk tolerance that North Dakota as a whole and Northeast Montana have, in that our board looked at it and said, we're not going to get into some of these real out there type of industries or business lines that don't fit an agricultural cooperative. And I've seen some cooperatives that started, down in the I-states, started marketing firms that were doing biodiesel and stuff like that early on. And it worked out phenomenal for them. But I've also seen a lot of cooperatives go into business that they don't know a lot about, and it maybe didn't work out as well. So I think, again, that goes back to the culture of our area where we say, you know what, we want to do what we know. And when something new and flashy comes along, someone else might make a buck on it, but that's okay because we're still able to make our dollar on what we know we're good at.
This is a good point of transition here. And you talked about risk tolerance there. You all serve a trade area, if I understand correctly, of more than 2 million acres, roughly. But you have relatively minor exposure to the typical row crop handle of many other cooperatives across the U.S. in terms of corn, beans, and wheat.
Yeah.
So I'd like to spend a couple minutes talking about that. So, what is the breakdown of the commodities you handle? You mentioned some earlier. And what differences does this require of Horizon Resources in terms of arbitraging supply and demand opportunities? Are these feeding short versus long supply chains? And the ultimate question is, how in the heck does a organization that is very prudent on risk manage commodity positions where there's no way to hedge those in the futures market?
I was just going to say, take everything I said about risk and throw it out the window. For every bit of careful and conservatism that we run through our agronomy division, we run through our retail division, we run with our equity management, our energy division is, very prudent. Our grain division takes all the risk and says, can I have some more? So we've got about 75% of our handle is durum. So that's a spring wheat. Durum is used to make semolina, which is what is your pasta. So if you go buy real pasta, not noodles, noodles will be made with spring wheat or a hard wheat, like a hard red wheat. So the difference is going to be, think of when you were in elementary school and you cut the noodle and it fell into 5 different pieces. That is not made with semolina. And then you think of Lady and the Tramp where they end up kissing. That was made with semolina. So the strength of that pasta really lies in the semolina, which we are proud in Northwest North Dakota of our durum production. So that ends up being, like I said, about 75% of our handle. And then about 15% is canola. So obviously with the low carbon fuel standard, that's been a real exciting market as the crush margins on canola and oil seeds in general has been super attractive. And then about 5% in spring wheat and 5% in pulses. So like peas, lentils, that type of stuff. So yeah, it's a real unique market. As far as hedgeable commodities, we have that very small portion of spring wheat. And then we've also there are mechanisms to hedge canola. Canola is traded up in Winnipeg. So if we were to hedge that, we also need to trade the Canadian US dollar exchange. And so it gets a little bit clunky. So we actually treat that as a cash commodity also.
And is it largely then given the fact that Durham semolina is going to go into food manufacturing, are you originating against pretty robust appetite in terms of supply agreements that you have, where it's kind of not truly back to back, but you know what the consumptive market's going to require of you? You've got those relationships. So what you're buying, you actually have it already sold. So it's kind of an off-market hedge, if you will, to kind of be sort of clumsy in my terms here.
I wish I could say yes, but no, it is very much, you think about the typical grain elevator, and they'll have basis risk, and they'll take, a couple 100,000 bushels of basis risk. And oftentimes we've got that with flat price commodity on Durham. And our members understand that, our board understands that, and our leadership team understands that. So that's the really nice part. You really need buy-in from all three, that your member owners are okay knowing that there's going to be years where it works out really well and going to be years where you maybe get pinched a little bit more. Your board has to be completely behind that as well. And then obviously your management, it takes a special type of person to be able to trade with that much risk on the table. This morning, and I know that this won't be released on the day that we're recording here, but this morning we got a text that Durham went no bid today. So that's the second or third time in the last 5 years that I've seen it go no bid. It can happen. Tomorrow, there will probably be a bid from this buyer. But, that's the type of stuff that you have to have a little bit of intestinal fortitude to be able to just sit there and say, we've done our homework. So the way we do our hedging and we do our risk mitigation is we do the math on supply and demand charts. And so AI has really helped with that. And we look at, which countries are importing, which countries are exporting, how much are they importing and exporting, what does production look like? And we're doing the math on, what do we think global supply is going to be? What do we think domestic supply is going to be? And really, one of the main ones we watch is North American supply. So, how much is Canada going to produce? How much is the US going to produce? So we do our hedging internally above the shoulders, and we try and, I don't want to say outsmart the market, but we like to have educated guesses on where we feel it's going to go. And at the end of the day, we just try and have more wins than we have losses.
Certainly. As I'm going to imagine it also from a recruiting perspective, to kind of continue to feed that bench of trading talent, you're also looking for a different profile of individual that can manage that much flat price risk and also, not have an aneurysm in the process of doing it.
I'm not going to lie, Joe. I have asked people in a very conversational way if they like to play blackjack in a job interview before. That's a good risk or a good gauge on how much the risk tolerance they have. If they're able to sit a blackjack table, even if you're playing $5, it doesn't matter, but just some type of tolerance to be able to say that, I'm okay with taking a little bit of a gamble. So yeah, we're always looking to add to our team. So if it sounds like an exciting opportunity and you're interested, look us up, horizonresources.coop, and let us know, because we're always trying to add. It's a very exciting environment. So it does take a special person though, for sure.
I love this idea of hedging above the shoulders and between the ears and trying to figure that out.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
The last thought that comes to me here is one of the situations, and I work for a large ABCD commercial grain handler, and the times that we left the market, which were not very often, but there were times in 2008 where 2009 stopped buying grain for periods of time, which that had repercussions with customer relationships, right? And it was a tough decision for us, a nearly impossible decision for co-ops, right? Where you're whether they're a member or not, they're your neighbor, and you have a very hard time, absent being full and no place to put it on the ground. You kind of have to receive the commodities. And I'm guessing that also has to factor in for you all, because how at some point you pencil out the S&Ds, you estimate the demand, you buy in the position that you think covers that demand, you're within the parameters that you've set above the shoulders and between the ears, but then there's maybe excess production within your trade area that is tributary to you. And in some ways, it feels like I'm speculating here, but you're almost encumbered by, you have an obligation to take it. And so is that part of your front end analysis as well as what do we estimate our obligatory origination is going to be?
So there's been one time that I went no bid to the farmer, and we were no bid for about 4 days. We went from $17.50 to no bid. We were long at that point, a substantial amount. Again, it ended up working out at the end of the year, so everything was fine. But when the market came back, we were at about $13. And I think we had no bid for 3 days, and it felt like 3 weeks. But it was, when there is no bid, and, the tough part is, when you're talking about corn, there might be a participant in the market that says, hey, you know what? I don't really have a bid, or maybe I'm backing off 50 cents. So it seems like I don't have a bid. That's great. In the durum market, there's really 2 players, maybe 3. And so when one of those goes no bid, it can either spook the other guy to no bid. It can, it's such a small industry. Mm-hmm. And so that's what really makes this unique is you can kind of figure out what the other person's bid is pretty easily. And so, it's a highly competitive environment between the 2 major buyers, and having the relationship is paramount. And the problem is, yes, this could tarnish a relationship. And, was I angry at the person that went no bid today? Absolutely. Because yesterday they had us raise our bids. And, but then at the end of the day, I still need them to be in the market, because we can't be in a market with 2 participants and only be using one. We're not doing our members true service. And so, there's certainly, it's a lot harder for us to go no bid. We deal with the farmer on a daily basis. And so to have that permanent relationship with them and be able to say, we've got your back, we're working on it, that's really important to us.
Very unique, well, maybe not unique. It's more and a more acute challenge that you all certainly have mixed in with your, flat price risk and things of that nature. So we didn't talk specifically about your asset footprint, but based on where you're located, the commodities that you handle, I'm going to assume for the moment that you do have a significant complex of truck houses within your organization.
We do, yep.
Okay. So we did an episode this past spring around ag's, what I call ag's asset problem, which is basically, and this is broadly distributed, it's not going to be true everywhere, but we really try to dial in on the challenges that the grain industry in particular has around managing profitable truck houses that lack both the space and the speed that is a dual requirement of the market now. We used to value space, and speed was nice. And now speed is a necessity, sometimes over space, right? Yeah. They want to get in and out quick. They want to be serviced quick and get loaded and leave, depending on which side of the trade you're on. And so these truck houses that lack space and speed, oftentimes, they're maybe not located on strategic waterways. They often don't have rail access. They're tough to staff because of the remote nature of the assets, because they're generally a little bit older, and they're very costly to maintain, right? Because of the retrofitting required and just the maintenance, because they're just, no one's built a new 4-pack in a long time, right? But there's a whole bunch of them out there. So all that being said, Levi, I'd love to hear how you look at the role of truck houses, both in your market with the commodities you handle, but also within your business and your strategy. Is it an encumbrance? Is it a value add? Is it something in the middle? And just kind of what's the relationship to the truck house is almost a sometimes necessary evil in this industry.
A lot to unpack here. If we were doing videos, the listeners would have seen me lean forward and get a little excited because it is one of my
wince a couple of times.
Yeah, it's one of my favorite things to talk about is big term strategy like this. So first of all, we ended up with truck houses because the railroads are all volume driven, right? And like I stated, our area is a lot of 35 maybe 40 bushel durum wheat. So that's where we are today in 2025. So if you can imagine, in 1980, we were substantially less than that. So there used to be a rail line, and I'm going to name a few small towns for your North Dakota geography buffs or anybody that's got Google Maps open. But north of Williston, there's Highway 50, which ran east to west. And we have 3 truck houses up there. There used to be a rail line. In the late 80s, that was pulled out. Watford City, which is the chair of McKenzie County south of us, a predominantly livestock area, especially, again, 30, 40 years ago, they used to have a rail line that was pulled out. And so that rail line used to go over towards Sidney, Montana. So that rail line no longer exists. The closest elevator for our McKenzie County patrons is 40 miles away, 45 miles away. No matter which direction they go, they can go north, south, east, or west, and they're 40 to 45 miles away. So they've got a substantial haul before they run into any assets other than our truck house. So what happened was we were operating these truck houses. Williston was a community of about 7 to 10,000, maybe if you're generous, 12,000 pre-oil boom. Oil boom hits, Williston balloons to 35,000 people. There is a lot of good that came with that increase in population. The bad news is I now have one farmer that comes in and tells me every time he comes in to sell grain, there are 9 stoplights for me to get to your elevator, where he can haul down the road and go to one of our competitors and not have any stoplights. So what that means is now, even though we have truck houses that handle grain at a discount, 60% of our volume goes through one of these truck houses before it comes into Williston. So they're an essential portion of our business, strictly because it helps avoid having to come into downtown Williston and having to deal with the increased traffic that comes. Nobody, when they're driving 85,000 pounds, really wants to be stopping 5 different times. So it really created an interesting dynamic from that standpoint. My belief is, in the cooperative world, we're supposed to provide service to the communities as best we can. Now, service has definitely changed. Does service mean today that operating that asset is the correct way? Or is it, we're going to invest in 2 or 3 extra trucks and we'll go up into that area and pick it up off the farm? So there's lots of different things that we're constantly analyzing, and each one of our locations has a slightly different answer. So we are constantly comparing on what trends are we seeing from that farmer up in that area. Is it an area that, as a collective whole, would rather haul to a different area because of speed, because of size? Well, that might be an area that's really hard to recruit talent to. And so we might have to make a decision on, okay, sending our own trucks up there and helping them empty a bin in one day, rather than them hauling. Even though they can haul to a faster elevator, it would take 3-4 days to empty that bin. So how does that service look? How does that service look different today? And we do that across all of our divisions. Should we be doing more farm direct stuff? Should we be looking at card trolls instead of operating retail locations, for gas stations? All sorts of different stuff that we're constantly evaluating to see what is the best footprint, what's the best way to do that. Now, because we have such a high volume that goes through those truck houses, we will always be in the truck house game. What does it look like, and to what degree? Are we putting in faster legs? Probably at some point. There's all sorts of different stuff like that we have to weigh. Now, the interesting part is what Northwest North Dakota, Northeast Montana, the average farmer has 130% of grain bin storage on their farm. So they can store 1 1/3 crops typically. Now, obviously, that's not every farmer. And, younger farmers are going to have less storage. We're seeing a mass transition towards the younger farmer across the U.S. So there's still some farmers that have extra space that are able to store stuff on their farm. So we get in a little bit different category, and we have to evaluate our market differently than if we were in Kansas. The first time that I drove through Kansas as a grain industry professional, I was like, wow, none of these farms have grain bins on them. Very different than up here. So yeah, it's a real unique area, and we try and weigh it out about if we were to make any adjustments, where's the right place to put our CapEx? And we look at total footprint, total handle, and staffing is definitely something we consider too.
Yeah, no, thank you for that. And what the episode that we did that got quite a bit of feedback, which was really great to know that we sort of hit on a topic of interest to folks. We focused heavily on sort of the tabletop exercise of, do these assets pencil or not? Yeah. And really kind of highlighting the variety of reasons why they become very challenging for a lot of folks. But you highlighted a couple of things that I think are really important. Is one, those bushels, that 60% of the handle that goes through a truck house before it finds its way to Williston. With the alternatives that they might have in terms of other truck houses that are more favorably placed with your competitors, you add that handle, that intermediary handle within the truck house, because those may be bushels at risk. Some portion of those might be bushels you wouldn't touch otherwise. At which point, then you need to pencil, okay, what's the value of that bushel relative to the cost to maintain the asset? And then you kind of figure out what makes sense there. The other thing that's interesting too is in the example that I put forward, a lot of times these truck houses become more acute problems or challenges for co-ops and smaller originators because they become so less attractive compared to the immediate alternative. Having the closest railroad 40 miles away, you've actually removed one of the things where maybe the farmer still would like the lake to be faster, the pit to be bigger, the truck flow to be smoother, the road to be paved, a variety of things. But the urgency, the temperature at the urgency is a bit lower because they're not saying, well, look, I can just drive another 6 miles and be home faster.
Yep.
And so that, not to say that gives you license to drag your feet, but it does change a little bit of the environmental pressure that you're operating under, for sure.
Yeah, it certainly doesn't. It changes it, like you said, but it does not give us a free license to manipulate markets or try and do anything like that. We still see some that are willing to hire third-party trucks and haul to one of those elevators that's 45 miles away. So we still need to be competitive. There's no doubt about that. And, we know our shortcomings at each one of our locations, and we evaluate that and say, at what point do we, what's our benefit and what's our cost here? Now, the one thing I will say, and you touched on it just real lightly, is so when we're in an illiquid market like we have with Durham, and a real specialty market like Durham, what happens is the more bushels you handle, it almost becomes a little bit easier because we're not stuck halfway between trains. We also typically will get a phone call before one of the neighbors. So we got the phone call. We know that we got it today, that no bid. We got that phone call before one of our competitors. So we were able to get our position in a better spot because they want to have that relationship. If they're going to tarnish the relationship with everybody, tarnish it with us first, and at least then we're a little bit in better graces than we were. So, our belief is by handling more bushels, it gives us a little bit more leverage in the market. And so we might have a truck house that brings us 500,000 to 1 million bushels, but it doesn't quite break even, but it helps that shuttle loader make extra money. So we're able to, at the end of the year, look at it and say, well, yes, P&L wise, that market isn't quite as attractive, but if that 500,000 to 1 million bushels were going to somebody else, what does that do for our market leverage? And so how do you put a value on that, Joe? I don't know that we've done it. You really have to rely on gut feel at that point. And so that all plays into it too.
Well, I think that's a good point, and something I failed to talk about in the prior episode I keep referring to, which we got so much feedback on. I think there's actually going to be a 2.0 of that episode to kind of recap what we heard. But there's an exercise here that it's a quantitative exercise that feeds a qualitative decision that you make. Is you clearly look at the consolidated P&L for a division within a co-op and say, okay, well, how did the grain division do overall? Right? And that's a very healthy, necessary exercise. What's the aggregate output? Now, if you stop there, a black P&L can hide a lot of mistakes. And so you also want to turn that kitchen light on real quick and watch all the roaches scramble and see where they run to. Right. You actually have to disaggregate the P&L and go back to locations and say, okay, within this overall picture that we're either happy with, thrilled with, disappointed with, whatever the outcome is, then you go back and look also and say, okay, the location by location level, how did this play out? And it's actually those two lenses taken together that ultimately will put you in the position to make the best decision on what do you do long term. Because you might say, yeah, this is an elevator that in its best year, in perpetuity, is going to maybe just be a hair north of break even. Mm-hmm. But in the aggregate, here's what it allows us to do. And so we're going to make what seems to be an unconscionable business decision of continuing to invest in an asset that doesn't generate a return because it feeds a greater return. Or similarly, say that there's assets that actually do fairly well, but we can replace or replicate their contribution with a distribution of volume to other assets. And so we might actually look at transacting an asset, selling it to a producer to make sure it's not a competitive asset in the future, because it actually simplifies things from our overall complex. So I think that it's looking at those both lenses. And then ultimately, as you said, Levi, we're hired to make decisions, right? At the top of the house, you got to aggregate that information, analyze, discuss, get inputs, and then ultimately it's going to come down to what does your gut tell you?
Right. And are they offensive or defensive assets too? I think that's something that gets overlooked a little bit too. Sometimes you go into an area saying, we're going to use this to gain market share. And sometimes, we've got 3 of them that are on the north side of our territory that I view a little bit as defensive as well. Because again, Williston is a 35,000 person community. So our bushel's going to want to come south. What we find is most of the bushels in between Williston and our northern assets will flow north. So they'll go up there first. And so if we didn't have those assets, how far north would they go? And that's something we don't want to find out. We don't want to find out that 30, 40, 50% of those bushels are willing to drive 60 miles up to our competitors.
That's right. Because once you realize it, then you've also taught them that they're also willing to do it too. And
absolutely.
Now you got to earn it back. We're coming up towards the end of our time here today. And one of the things I did want to highlight, because it is, again, we've had a couple of folks on that do podcasts and content creation, but you guys have taken a very interesting angle in your show. And so I guess I'd like to give you a few minutes, Levi, to maybe tell us a bit about the podcast from Horizon Resources and specifically the angle you've taken around educating your membership in a pretty broad sense. And so I'm not going to front run you here. I'm just going to tee it up and tell us about the podcast and what the things are you talk about and what you're trying to accomplish with that.
Sure. Yeah. Our podcast is called On the Horizon. And this was something where I had seen a couple other cooperatives start messing with podcasts a little bit. And one of the things I didn't like was they seemed real sporadic, and I need to have a schedule. I want to be, you could call it a little bit type A, and I want some structure to it. If I'm listening to a podcast, I want to know that it's coming out on a set schedule. So that being said, we looked at that. We looked at the podcast space. We used to do a quarterly newsletter, and it was a magazine format, and it was a really well done magazine. We were able to usually sell ad space in it, and it was good, but print costs have gone up. So we looked at it and we said, okay, about $25,000 per run to do this magazine, or for $10,000 to $15,000 per year, we can do a podcast where we're outsourcing all of our editing. We're not tying up our people's time with that. And what we're able to do is we can record an episode on a Thursday and release it Friday. So we release every Friday. I think I said it. On the Horizon is the name of our podcast. Obviously a play on Horizon Resources name. I host it, and we have a lot of different conversations on there. But the general premise of the show is we're trying to educate our member owners that just because you pulled over the pit and opened the trap, that grain didn't disappear. When you pulled in the spring with an empty truck, that fertilizer didn't just appear. You pull in to get your chemical, that didn't just appear. There's a whole network that happens. There's millions of dollars worth of decisions being made by our staff here. So to be able to educate these people about the talent that works at their cooperative and then teach them about the entire network. So we've had high up executives at CHS on the podcast to talk about their side. We've had global traders talking about how the global trade works. And then we've had our own staff on talking about the current production cycle and do we need to be looking at fungicide right now? So we really cover this broad breadth of information that all ties back to their local cooperative and teaches about the entire network and teaches about what we're doing, what we're seeing. And we have a handful of different staff members on. We try and include a bunch of different people from all of our locations. So it's really cool. But the general vibe is supposed to be very conversational. And our marketing director said it best when she said, the goal is to feel like we're at the table at their farm and it's lunch and we just finished eating and we're about to go back out to work and we're having that little BS session right before we head back out. And that really encapsulates what all this is supposed to be.
Thank you for that. And it's we'll make sure that we get a link to it to put in the show notes so folks can check it out, because I think it's going to be beneficial not just for the members and the owners and the customers of Horizon Resources, but also for folks across the industry, both producers and other co-ops. One of the things that I think is really interesting here is that broad scope you've taken around educating your customers and your membership, and frankly, educating your owners.
Yeah.
Because as you said, there's a lot that happens behind the pit.
Yeah.
A lot happens behind the shed. And so helping folks understand what the operational complexities are of an agronomic business or a grain division, helping them understand what does $1 million get you in machine guarding, right, and safe walkways for employees so they're not exposed to unnecessary, falling risks or machine guarding risks or other risks that are presented in the elevators, helping folks understand how decisions get made.
Yeah.
Around, maybe if no bid became a more common thing, helping folks understand, well, what actually has to happen for that to culminate in someone taking a difficult decision to go no bid in a given day or a given week. Because, these folks your members own that business.
Absolutely.
And understanding what happens. And as a brief aside, we worked with a co-op and was part of a discussion. There was a very contentious amount of feedback in Facebook chatter. This is with a Western U.S. co-op, Midwest to Western U.S. co-op, around corn that had been put on the ground in a ground pile. And decision taken based on the short hold period not to tarp it. And so it predictably formed a rich golden brown that then became a black crust across the top of it. And there was a significant number of producers in the area that were really upset because from their point of view, we delivered this corn, this beautiful production that we put our heart and soul into, put our capital at risk, lost time with our families to produce this crop. We dumped it and you guys are just letting it rot in the field. Perspective from some members of leadership and location are, well, that crust is actually exactly what we wanted because underneath it, it was beautiful number 2 yellow corn, and we blended off 100% of that crust without any discounts. And so we saved money on tarp, we saved money on labor, we saved on the risk exposure of putting people out there to tarp and untarp that pile. And this worked out exactly as we wanted to. Now, whether you think a black ground pile is good or bad for a co-op or however you feel about it, that's an example where talking to your membership about how the decision's made and what else might be happening underneath that 2-inch crust is really important. And I don't know if it happens enough outside of someone coming in and saying, oh, I trust Levi. I'm going to go bend his ear for a while because I'm upset about it. And then you can explain it to him.
Well, that's no fun.
So kind of a long story, but I think that's really important. I think more people, if you're not doing something to educate your ownership, take this as a call to action to think about it. Not necessarily a podcast.
Yeah.
But a newsletter, a quarterly, a town hall, a video, whatever it might be.
So there's 2 things I want to touch on that. First of all, I absolutely love that the patrons cared enough about that cooperative that they were questioning the decisions that were being made, and they were good questions. Yes. I don't agree with how those questions were being asked, right? You're doing it on Facebook. Go in, talk to the leadership, and find that out. Now, what we've done, obviously, with the podcast is we're able to get out in front of that. So we had our net local was a little bit lower than we wanted it to be this year. On our year-end recap, what we did is we had our CEO on here and we talked about why was our net local lower? Well, the grain markets didn't really cooperate this fall. So we had some locations that were 20% of their 5-year average for their handle. Obviously, that's going to have a pretty negative impact in 2024. Now, 2025, we would expect those bushels to come flooding back in. So what's that going to do for 2025? We were able, as a cooperative, to be out ahead of that message and tell our side of the story about what we're looking at, what we're watching, why we see what we see, and where our concerns really are with the cooperative. And we're able to give that honest messaging and be out there. Now, I've seen a lot of different cooperatives do phenomenal things. It does not have to be a podcast, like you said.
That's right.
I've seen some that do coffee with the CEO once a week or once a month. There's some that, it really has to just fit whatever you guys want to do. And your footprint is going to dictate that as well. But I would encourage everyone to think a little bit outside the box. Could it be a Teams call that people are able to join, no different than an earnings call, right? And they're able to ask questions. Could it be, lots of different modern ways to do this rather than, having to do the old quarterly magazine like we used to do. Not saying that they're bad, but we found it was really difficult for our agronomy or grain teams to predict what was going to be happening in the market or in the season by the time that actually hit the mailbox, because you're writing that 30 to 45 days out.
Yeah.
So
that's great. Well, we are near time here, Levi. I did want to give you time for the last point that I know you're very passionate about. So you talked earlier about these ways reaching out to membership helps them get to know and understand the talent within the organization. Mm-hmm. You talked about looking at how do you maintain assets from a talent perspective? How would you maybe invest in or build assets, and what will it be to staff those assets? Talked about trading and, looking the unique talent needs to actually backfill the unique type of merchandising arrangements that you guys have. What is your point of view around talent in rural America? The headline news is there's not enough people.
Yeah.
But it's not necessarily just about number of bodies.
Yeah, it's definitely about talent. So I'm on the North Dakota Grain Dealers Association Board of Directors, and I will say I have the joy of serving with some of the brightest individuals that I've ever met. And so I know that if you go on X and you look at all of the ag chatter on there, the local cooperative gets a lot of flack. There are so many talented people that are sitting at local cooperatives. So if I were coming up in this industry or interested in going into this industry, don't think you have to go the corporate route to go meet the smartest people that you've ever met. There's a lot of people that I get to talk with at conventions or meetings throughout the year that are talking about EBITDA multipliers also. It doesn't have to be something that's reserved for the big cities and wearing slacks to work. They're the blue jeans people out in the country. There are some very, very intelligent people. I think that there has been a lot of growth in that talent in the last 5, 10, 15 years, where some of it, due to mergers and acquisitions, has been forced, right? We need talented people. We need people that are thinking about this the way investment bankers think about this. We need to be thinking about this differently than the cooperative used to. And so I would encourage you, if you're an intern looking for an opportunity, find an internship out in the country, find one in the cities, whatever. But get in, dive in. Like I said, the North Dakota Grain Dealers Association. So we have an annual convention in Fargo, North Dakota, which is where the state school is. So the ag programming is all right there in Fargo every January. Find out where your local industry association, a lot of them are going to be agribusiness associations or whatever. Find out where their meetings are. Find out how you can start networking with those people. I know they're looking to hire. I'm guaranteeing that right off the bat. I already did my hiring plug, so I'll do another one. But yeah, look up those people. But there are some phenomenally smart people you can learn a lot from. One of the smartest people that I've learned from managed an elevator in a town of 500 people. So don't think that you have to be where Taylor Swift is going to hold a concert in order to get a good experience.
Yeah, the through line being there that, don't forget that smart people wear blue jeans to work too.
Yeah.
And knowledge, expertise, and good instincts are broadly distributed. They're not just sitting in metropolitan areas. And I can wholeheartedly agree, Levi. And so thank you for your passion around that. And also just thank you for taking the time to join us today. I really appreciate it.
Absolutely. Thanks for having me on. And look forward to maybe having you on our podcast sometime or coming back on sometime. So
would love both those to come to fruition. Well, we'll make sure that we have links to you on LinkedIn and links to the podcast and Horizon Resources online. And so in closing, I want to also say thank you to our listeners for joining us and being part of the Pacesetter Pod today. I hope that you found something not just of interest, but of actionable value in our conversation today. And if you did, the one thing I'd ask you to do is consider sharing this episode with someone that you think would find similar benefit. It's the very best way you can support the show. and also help us elevate thinking around strategy execution across the ag supply chain. I look forward to having you join us again right here on the Pacesetter Pod.
This is the podcastfactory.com.